This is Chapter 11 for income tax planning. So we're going to talk about asset categorization. So all assets are capital assets except for accounts receivable, creative works in the hands of authors, except music copyrights, and inventory. Those would be considered ordinary income assets. And then Section 1231 assets are depreciable real or personal property held for the use in a trade or business or production of income. Taxation of capital assets. So long-term gains generate a lower tax rate than ordinary income taxes, which could be 0, 15, 20, 25% for recapture on 1250, and 28% for collectibles. Long-term losses are limited to a maximum of $3,000 against other income per year, but carry forward indefinitely. So if you look down here, it shows income. It could be ordinary, which would be the sale of inventory, or it could be portfolio, or it could be passive. So there's an additional current 3.8% Medicare tax, which applies to the lesser of net investment income or modified AGI over the threshold amount not indexed of $250 for married filing joint, $125 married filing separate, and $200 for single. Net investment income includes portfolio income, income from passive activities like rental, gains or dispositions of property, but does not include distributions from qualified retirement plans or IRAs. Therefore, capital gains for those above the threshold amounts would be taxed at 18.8 or 23.8 instead of 15 or 20. Talking about the sale or exchange requirements. So we talked about realization. So there's a difference between realization and recognition. Realization is when the sale occurs. So you don't realize a gain or loss until the actual sale occurs, or the casualty or theft happens, or corporate bankruptcy, which is a worthless security. But when you recognize the gains, realized gains must be recognized unless Congress defers or excludes the gain from income. So let's talk about an example. After conducting a thorough investment portfolio analysis, Collison decides MNL Inc. stock no longer fits his asset allocation and sells the shares of MNL that he owns on the open market. The sale constitutes a realization event. Collin will calculate gain or loss, and absent a special code for deferring or exempting any gain, he will have to recognize any gain on his individual tax return. On December 38, so this is an example of a worthless security. On December 28 of last year, Casey purchased 1,000 shares of Heidi Industries, Inc. The investment was not one of Casey's best investments, and the company declared bankruptcy on January 5th of the current year, and the security became worthless. For federal tax purposes, when the security becomes worthless, a constructive sale happens on December 31st of that year. Therefore, Casey will have to recognize a recognition event due to bankruptcy as of December 31st of current year, which would make this longer than 1 year, or therefore a long-term capital loss. To calculate a gain, we take the amount realized, very sensitive. Amount realized minus the adjusted basis equals realized gain or loss. How do we get to adjusted basis? So it would be the cost of the property, which could be stock or a property, plus any capital additions minus any cost recovery, which is depreciation, equals adjusted basis. So let's talk about an example on a personal asset. Brendan purchased a Ferrari 10 years ago for $80,000. He used this for personal purposes and sold it earlier this year. Because the model was a limited edition, he was able to sell the car for $90,000, even though he used it for over 10 years. Calculate his gain. Amount realized, $90,000, minus his adjusted basis, what he paid for it, equals a $10,000 gain. He would have to recognize a $10,000 gain on his personal tax return. Disallowed losses. So disallowed losses are losses or sales on conversion of personal assets, losses on a gift or sale of property to a related party, and wash losses. Wash is when you sell a stock and you purchase and sale within 30 days. It's a resulting 61-day window before or after. And unrecognized loss is added to the basis of the replacement securities. What they don't want you to do is sell a stock for a loss and then within a 30-day window buy it back again, just so you could recognize the loss. So they don't allow you to recognize the loss. Example of a personal asset loss. Helen purchased a personal residence 16 months ago for $290. She lives in a city that has been heavily affected by a current recession and needs to sell her home and relocate to a lucrative job offer. The best offer she receives is $265. She sells her home and suffers an economic loss of $25,000. Her loss on her personal asset is not tax deductible. An example of a loss on related party transactions. Maxine purchased Triton stock 3 years ago for $30 a share. The stock is currently valued at $25 a share. She decides to gift her shares of Triton to her son Justin. Justin immediately sells the stock for $26 a share. The $5 loss that Maxine incurred during the holding period will never be recognized because it is a disallowed loss. Justin has an economic gain of $1 per share and no taxable gain because we have what is a double basis rule when you gift shares that currently have a loss. Wash sales. So Michael reviews his portfolio and decides to sell 100 shares of Bear stock on November 1st for $20,000 to offset his annual gains. Michael purchased the stock 2 years ago for $30,000. He subsequently reads in an investor's report that Bear stock has a new patent for a potentially high revenue product. On November 20th, Michael purchases 100 shares of Bear for $15,000. Michael will not be able to recognize the $10,000 loss on the original share sale due to the wash sale transaction rules, purchased within 30 days. The loss will be added to his new basis. So his new basis is $15,000 plus the $10,000 loss, which is new basis of $25,000. Capital gains holding period. It would be long-term if it's more than a year and short-term less than a year. A long-term gain example. Chris purchases 100 shares of Dowling Novelties stock on March 17th for $10,000. On March 18th, the following year, he sold the stock for $12,000. Chris has a $2,000 gain, his amount realized minus adjusted basis, and it will be treated as long-term because he held it for more than 1 year. So let's talk about some special holding period rules. Property received from a descendant. If it's from death, it is considered long-term. If it's a gift, if the fair market value is greater than the basis of the gift, add the holding period to the donee or donor. If the fair market value is less than the basis of the gift, the gain basis is used on sale, so double basis. You have a gain basis and a loss basis. And you add to the holding period. If there's a loss basis that's used, the holding period starts on the date of the gift. If a related party transaction sale, the holding period begins on the date of the sale. If there is non-business bad debts, it's always short-term. And then if you have a non-taxable exchange, the HP of the replacement asset includes the holding period of the original asset. So here's a summary. If it's inheritance, it's long-term. If it's a gift, holding period will be tacked on to the donor's holding period if gain. If loss, it will be the donee's holding period. If it's a related party transaction, the holding period starts on date of sale. And if it's non-business bad debt, it's short-term capital losses. So talking about the capital gains rate. So collectibles would be taxed at a higher rate, and then unrecaptured section 1250. So the effective rate may be more than the maximum capital gains rate, which increases at a taxpayer's AGI. Capital gains and losses must be separated from other types of gains or losses for two reasons. Long-term capital gains may be taxed at a lower rate than ordinary, and net capital losses are only deductible up to $3,000. So this is why you would need to separate long-term capital gains and losses. Non-corporate taxpayers. So capital gains and losses must be netted by holding period. So the first thing we would do is net short-term capital gains and losses, then net long-term capital gains and losses. If possible, long-term capital gains and losses are then netted with short-term. If the result is a loss, so we first net short-term, then we net long-term, then we net short-term and long-term together, and if the result is a loss, then the net capital loss deduction is a maximum of $3,000 per year. Unused losses retain their character, either short-term or long-term, and are carried forward indefinitely. So if you had a $15,000 gain short-term and a $10,000 loss short-term, you would have a net short-term gain of $5,000. And if you had a long-term capital gain of 3 and a net long-term capital loss of 5, you have a net long-term capital loss. Then you would net these two together to result in a 3,000 net short-term gain. So 5,000 minus the 2,000, so 3,000 is what we would include as a net short-term gain for capital. Net capital losses can generally only offset capital gains and may be used as a deduction against other sources of income. Up to 3,000 of net capital losses can offset other income. Up to 50,000 single and 100,000 married filing joint losses on Section 1244 stock can offset other income. We'll talk a little bit about 1244 stock in another chapter.